Welcome to Talk Tickers. Today, we're diving into Amphastar Pharmaceuticals, ticker AMPH. Their Q3 earnings report was a really interesting one. You see, they posted a strong beat, but the stock actually dropped right after. So we're going to dig into why that happened, and more importantly, what it means for the stock going forward. So here's the big question, right? Amphastar beat its adjusted earnings estimates by 12%. Now, you'd think that would be fantastic news, the kind of thing that sends a stock flying. But nope, the immediate reaction was a sell-off. What on earth did the market see that the rest of us missed? That's the puzzle we're going to solve today. And just look at this. Talk about a roller coaster. On earnings day, the stock fell over 4%. But then, over the next few days, it did a complete 180 and rallied more than 12%. This kind of whiplash tells you the market's first reaction was probably wrong, and it had to quickly reevaluate what was really going on under the hood. Okay, so let's look at the numbers that everyone saw first. On the surface, things looked great. Revenue beat expectations by more than $7 million, and the non-GAAP earnings, the adjusted number everyone watches, came in at 93 cents. That's a full dime higher than Wall Street was looking for. So yeah, the headline story was a clear beat. No ambiguity there.
So if the headline numbers were so good, what gives? Why the drop? Well, this is where we have to dig a little deeper, because the optics of this quarter were, let's just say, a bit messy. The devil really was in the details.
And boom, here's the smoking gun. While those adjusted non-GAAP earnings were a solid 93 cents, the official by-the-book GAAP number was just 37 cents. That is a massive gap. And you know when traders see a disconnect that big, their first instinct is often to sell now and figure it out later. They just assume something's wrong.
So what caused that huge difference? It really boiled down to two big one-time charges. First, the company set aside about $23 million for a litigation issue they're appealing. Second, they made a $5.3 million upfront payment for a new licensing deal. Now, the key thing here is that neither of these has anything to do with the core day-to-day business performance.
But the impact of those charges on the official numbers? Oof, it was severe. It made the GAAP operating margin look like it fell off a cliff, dropping by 1,640 basis points. For any computer-driven fund that screens for margin compression, that is a gigantic red flag. It's an automatic sell signal, no questions asked.
But here's the thing. Once the market had a minute to breathe and actually look past that ugly one-time margin hit, it found a much, much better story. And that story is about Amphastar's huge pivot away from lower-margin generics and towards its own higher-growth proprietary drugs. And the star of this pivot is, without a doubt, BAQSIMI. That's their ready-to-use nasal powder for severe low blood sugar. In Q3, it had its best sales quarter ever. I mean, think about this. It now makes up almost 28% of the entire company's revenue. This isn't some side project anymore. This is becoming the core of Amphastar.
And you can see this strategy playing out perfectly in the numbers. BAQSIMI revenue shot up 33%. At the same time, sales of their old injectable glucagon product collapsed by almost half. They are literally eating their own lunch with a better product. And for a growth story, that is exactly what you want to see.
And management is being crystal clear about their goal here. They are on a mission. They've put a line in the sand, saying they want their own proprietary products to make up half of their pipeline by 2026. That gives all of us investors a really clear target to measure them against.
Okay, so the big question is, how are they actually going to get there? Well, the good news is the company gave us a pretty clear roadmap of the catalysts we should be watching over the next year and a half.
So here's that roadmap. They're already launching a generic iron injection. That's happening now. Next up, in the fourth quarter, we're watching for a potential approval of their generic teriparatide. And then, the really interesting one could be in the first half of 2026. They have a date for a complex inhalation product, AMP007, where they think they might be the first to market. That could be a big one.
So you take all those pipeline catalysts, and it all leads to this, management's guidance for the future. They're basically saying 2025 is a bit of a transition year, but in 2026, they expect to get back to real growth, targeting anywhere from high single digits to low double digits on the top line.
All right, let's put it all together and make a call. To figure out our rating, we've got to take that positive long-term story and weigh it against some of the very real risks that are still out there in the near term.
So the bull case is pretty straightforward, right? This pivot to proprietary drugs is working, BAQSIMI is on fire, and that pipeline is full of potential. The bears, though, they're going to point to the margin pressures from the old generic business, that litigation risk that's still hanging out there, and the simple fact that the company has to execute perfectly on all these new launches.
So after weighing all of that, our official rating is market perform. Look, the strategic pivot is absolutely the right move, and it sets them up for a much better future. But those near-term headwinds, the margin pressure, the execution risk, they're real, and they're big enough to keep us from getting more aggressive right now. At this price, we think the risk and reward are pretty balanced.
But hey, a market perform rating doesn't mean you just have to sit on your hands and do nothing. For those of you looking for a way to play this transition, that brings us to our trade idea.
Okay, so the strategy we like here is selling cash-secured puts. We'd look at a strike price down around $22.50, which is a nice cushion below the recent lows. You sell a put that's about 3 to 6 months out, and the whole idea is you collect a premium, you get paid up front by taking advantage of all the volatility around the stock right now.
We love to call this a paid-to-wait strategy. It's a win-win, really. If the stock stays above your strike price, you just pocket the premium you collected. Free money. If the stock does pull back and you get assigned the shares, well, now you get to own a piece of this great long-term story at a significant discount to where it's trading today.
And of course, as always, we have to say it, this is not financial advice. Please be sure to do all of your own research before making any investment decisions.